Hello, and welcome to the Geopolitics Explained podcast. I planned on continuing the discussion on the United States and fiscal dominance today, but last Wednesday we saw the UK release its budget, and this is somewhat relevant to the topic of fiscal dominance. The UK is notable as one of the many developed economies that is struggling with stagnating growth, high debt burdens, and demographic pressures. This budget influences the UK's international competitiveness, its position in global markets, and its soft power. Because of these implications, it's important to understand the measures from the budget and why the UK is pursuing them. Today's episode will set the scene, exploring the key takeaways from the budget and who will be affected by these policies. And next episode on Friday, we will dive into the financial reality in the UK. We'll do this by exploring the political impacts and, in general, why politicians in stagnating, developed economies of today are facing huge tailwinds in maintaining their positions in power. But for today, let's dive into the key policies in this budget. First, we have tax and income-related measures. The biggest policy, and the one that has grabbed the most headlines, has been the tax burden in the UK being raised to a post-World War II high, with income tax and national insurance thresholds frozen until 2031. This is expected to raise an extra £26 billion in tax revenue by Parliament end. We've also seen an increase in tax rates for income from savings, dividends and property, with all rising 2%. Pension contributions via salary sacrifice have also been changed, with only the first £2,000 exempt from national insurance payments. We've also seen reform to capital gains tax relief and carried interest, the implementation of a mansion tax, a tourist tax, a milkshake tax, and changes to gambling tax. Finally, we've seen the cash ISA limit lowered to £12,000 a year from £20,000 a year for under 65s. This will come into effect in April 2027. Moving on to welfare now, and the biggest policy was the scrapping of the two-child benefit cap. We also saw the state pension increasing 4.8%. For workers, the national living wage will be rising to £12.71 from April 2026. We also saw universal credit rise by 6.2% and other benefits rise by 3.8%. And we saw the extension of free school meals and free breakfast clubs. Moving on to cost of living now, and £150 will be expected to be deducted from household energy bills from April 2026. This is savings made by the government to businesses, and the expectation is that these businesses will pass these savings on to consumers and households. We've also seen a one-year freeze implemented on train fares and prescriptions. When it comes to transport, we've seen a pledge that the Labour government will continue investment for the Lower Thames Crossing and Northern Powerhouse Rail. We also saw a new mileage-based system which will be implemented for electric vehicles and plug-in hybrids. Finally, we saw an extension to the fuel duty freeze, which will now be extended until September 2026, with gradual return planned for March 2027. When it comes to infrastructure and public spending, the budget stated that the government would continue to improve public sector asset efficiency. They will continue funding the NHS and education, as well as providing extra funding for Northern Ireland, Wales and Scotland. The budget also included £13 billion, which will be sent to local mayors. Final section that we'll cover is industrial strategy. We saw the budget reiterate support for technology firms and UK startups through various measures. We saw nuclear power continue to be supported with small modular reactor projects set for Anglesey and further support for the Sizewell C nuclear power plant. We also saw the budget discuss investment in skills and apprenticeships, with £1.5 billion pledged to support 16 to 24-year-olds and free apprenticeships for small and medium-sized enterprises. Now, the budget had many more policies, but these were some of the key policies that were discussed. These policies in isolation don't mean much unless we explore the consequences of their implementation. To do this, we have to look at how these policies will affect different groups of people in the UK and how this will translate into the broader economy. Before diving into specific groups, one of the main areas of criticism of this budget has been that of fiscal drag. This process involves freezing tax thresholds. With these thresholds frozen, should someone find themselves making more money over the coming years, they could find themselves paying more tax as they get dragged into higher tax brackets. This occurs despite there being no actual rise in tax rates, and this is referred to as a method of stealth tax. With this being one of the biggest policies from this budget, how will this and the other policies affect different groups in the UK? Firstly, we'll start with pensioners. Those who are retired and above the state pension age will benefit from a 4.8% increase in their state pension from April 2026. This amounts to roughly £575 extra per year. Those who retired before April 2016 will see less of a benefit of around £439 per annum. Pensioners will also benefit from frozen prescription charges and from extended winter fuel payments. However, due to frozen income tax thresholds, some pensioners could be dragged into higher tax brackets, which will see them paying income tax. As a result of this, the net result for pensioners is modestly positive for most. Moving on to workers now, and the national living wage will rise to £12.71 per hour, giving a boost to low-paid workers. Freezes on rail fares and prescriptions could also reduce some everyday costs for workers, but the freezes on income tax and national insurance thresholds will once again see workers gradually paying more tax as their wages rise over the years. As a result of the freezing of the tax thresholds, 920,000 people are expected to become higher rate taxpayers. Overall, the net result for workers as a result of this budget is negative. When it comes to students and graduates, the repayment threshold for Plan 2 student loans has also been frozen at £29,385 until 2030. Any graduates who make more than this per year will begin to repay their student loans. As wages rise, this will mean a greater financial burden on working graduates. But students will also be impacted by frozen tax thresholds for income tax and national insurance, which will further increase the burden upon them. For students or graduates who are in a position to save, reducing the cash ISA allowance to £12,000 limits easy saving for younger people. For those wishing to enter the housing market, the scrapping of the lifetime ISA will require a suitable and sufficient replacement, which is under consultation. If this isn't a suitable replacement, entering the housing market will become even more difficult. As a result of these changes, the net result on students and graduates is largely negative. When it comes to welfare recipients, the scrapping of the two-child cap on benefits will lift hundreds of thousands of children out of poverty, and the increases in universal credit and other benefits will also provide additional support. However, the budget did include some reductions in some schemes, such as Motability, which may affect some groups. As a result of this, the net result for welfare recipients is largely positive. Moving on to investors now, and taxes on dividends, savings income and rental income will rise by 2%, which will reduce after-tax returns for investors. The cash ISA reduction to £12,000 will also limit tax-free savings and will discourage cash saving. The question is whether investors will invest more in the UK market or if they will find alternative gains outside of the country. The net result on investors due to this budget is negative. Moving on to businesses now, and relief such as gas and electricity savings will help support small businesses by reducing their costs. The support for UK startups and for skills and apprenticeships will also support smaller businesses. But increased tax burdens on individuals could dampen consumer demand. As a result of this, the net result for businesses is mixed and will ultimately be told with time. Moving on to homeowners now, and the £150 savings on energy bills is expected to be passed on to consumers, and this will benefit homeowners. Homeowners below the high value threshold will see little negative impact from the budget's changes, but the opposite can be said for those above the high value threshold. The council tax surcharge from 2028 will increase their annual housing costs, and higher taxes on property investors and landlords will further reduce income. As property prices rise, more people could be susceptible to higher payments via council tax. The net result for homeowners as a result of this budget is neutral for most, but negative for rich homeowners and landlords. When it comes to the youth, we will see that young workers will benefit from an increased minimum wage, but even those on minimum wage could surpass the £12,270 tax threshold, reducing their long-term financial stability. On the flip side, support for skills and apprenticeships is incredibly promising. The UK has suffered from reduced domestic manufacturing and from a less skilled workforce, and support for apprenticeships and skills is vital to begin addressing this. Again, the net result for the youth is mixed. Moving on to public service users, and increased government spending in health, schools, social infrastructure and transport should see benefits if this is followed through upon. However, this will take time and will likely be impacted by low productivity, which the OBR baked into its forecast. The net result for public service users in the UK has the potential to eventually be positive. Moving on to drivers now, and the fuel duty freeze is expected to save motorists £40 a year. On the opposite side, an electric vehicle mileage-based tax could deter adoption of electric vehicles and could impose further costs on those who possess them. As a result, the net result is neutral for internal combustion engine vehicle drivers, but the budget is largely negative for electric vehicle drivers. The final group that I will discuss is renters. The recent renters' rights reform will see landlords face higher operating costs, higher regulatory risk, and reduced flexibility in evicting tenants. If we couple this with the budget, landlords will also see higher taxes on rental income. For renters, these higher costs could well be passed on to them where this is allowed, which will see little relief. Also, the OBR expects that rents will rise further if landlords leave the market. While some renters could be in a position to become first-time buyers, the overall effect on renters from this budget is one of greater pressure and not of more protection. As a result, the net result for renters has the potential to be negative. In general, this budget appears to shift more of the tax burden onto wealthier individuals and high-value homeowners, while boosting support for low-income families and low-wage workers. For savers, investors and the middle class, the impact leans more negative than positive, as fiscal drag is set to increase tax bills over the upcoming years. This is coupled with elevated inflation, which will eat into wages. This also combines with the frozen tax thresholds, and based on history since 2008, it's unlikely that wage growth will outpace inflation. This further eats into purchasing power and negatively impacts the cost of living issues that some in the UK already face today. The freezing of the tax thresholds has also led some to accuse Labour of breaking their promises from their manifesto not to raise taxes. We now know how different groups in the UK will be affected, but how will this translate to the economy? And how will this translate politically? Will these changes make a meaningful difference, or is the UK still set to suffer from a lack of confidence, low growth, and stifled productivity? It's these questions that we'll answer next episode. This will be released on Friday. That's all for today. If you enjoyed this episode, why not leave a review on the podcast platform of your choice? It really helps out the podcast. I've been Dylan, and I'll talk to you next time.